Good afternoon, everyone, and thank you, Greg, for that very kind introduction. And my apologies to my NABE hosts for stepping down so rapidly as one of the Finance Roundtable co-chairs. It's a distinct pleasure to welcome you all to Philadelphia for this year's annual meeting. I'm especially glad to be here with all of you, people who think deeply about the economy and how economic developments impact families, businesses, and communities across the country. As an economist, I've learned as much from direct conversations with some of those families, businesses, and communities as I have from studying data and models. And that's why I feel such a strong connection to NABE and the work that you all do. As you know, the Federal Reserve System is committed to serving the public by fostering conditions that lead to stable prices and maximum employment. As president of the Philly Fed, I look deeply and widely at the economic data and complement that with perspectives I've gained from talking directly with people in the communities that we serve. Those conversations allow me to bring regional insights to our broader analysis of the economy and monetary policy. And they help me to keep front of mind the ways in which FOMC decisions impact all of us. I'm looking forward to talking with Greg and taking your questions. But first, I'd like to take some time up front to describe how I see the economy and what I believe this means for monetary policy. And before I do that, let me emphasize that the views that I express today are mine and not necessarily those of my colleagues in the Federal Reserve System or on the Federal Open Market Committee. Let's jump right in. The latest available data, and I will pause here as well and emphasize available, suggest an economy that is doing pretty well, although inflation does remain elevated. Economic activity generally came in above expectations over the summer, with a strong showing from the US consumer, as well as strength in business investment. After declining in the first quarter, real GDP grew at a 3.8% annual rate in the second quarter, and early indications are that above-trend growth will continue in the third quarter as well. The unemployment rate was 4.3% in August, near what I would characterize as full employment. But unemployment is up from 4.1% in June, and the August employment report suggests that momentum in the labor market is to the downside. Job gains have slowed markedly, but labor supply and demand appear to be slowing more or less in tandem, leaving overall conditions in a rough balance. I'm hearing similar sentiments from employers who can find workers when they need them, but generally describe being in a low hire, low fire stance. Total PCE inflation came in at 2.7% year over year in August, and core PCE was a little higher at 2.9%. While inflation continues to be above 2%, it is down significantly from pandemic highs. And this process has come with an assist from restrictive monetary policy. With the Fed funds rate currently at 4 to 4.25%, I see policy today as modestly restrictive. Let me take a minute to describe how I think about tariffs and inflation. My base case is that tariffs will increase the price level, but they won't leave a lasting imprint on inflation. And given this base case, monetary policy should look through tariff effects on prices. Why? Let me start with the economics. Here, the lessons from economic theory are clear. So long as expectations are anchored, increases in prices due to supply effects do not turn into an inflation problem. Going beyond the theory, the data so far have largely been consistent with this view. We're definitely seeing the effects of tariffs in the inflation data. The increase in goods price inflation is clear. But relative to what our analysis predicted, tariff-induced price increases have been somewhat smaller than anticipated. Now, we have seen some strength in services prices as well, and this bears watching. It would be a problem if tariff-induced price increases spill over to inflation more generally. That said, I don't see conditions as supporting problematic spillovers right now. First, labor market conditions are very different than they were during the pandemic, when turnover was elevated and workers were job hopping to get higher wages. Some of my contacts have described lowering starting wages, for example. This is not what I would expect to hear if the labor market was going to be a force that accelerated inflation. Second, many firms report being focused on preserving market share, and this makes them motivated to find creative ways to avoid passing along increased costs. Finally, Monetary policy is modestly restrictive and has been for some time. The flip side of the famous long and variable lags axiom is that the effects of past policy persist over time. For me, the bottom line is I simply don't see the type of conditions, especially in the labor market, which seem likely to turn tariff-induced price increases into sustained inflation. But I reach this conclusion with an awareness that we need to be careful. We've heard a lot about how uncertainty is delaying some investment projects. When there's greater clarity, we could see a burst of growth. And after 4+ years of above target inflation, it's important to consider the ramifications. Firms have had a lot of practice raising prices, and consumers have had to get used to a lot of price increases as well. My own research has focused on how living through things like financial crises can impact future behavior. So I am sympathetic to the idea that the experience of the last 4 years may leave an enduring legacy. And that's another reason to proceed cautiously. I do still expect some additional goods inflation over the next few quarters, due in part to current tariffs working their way through and also to new tariffs that have been announced. This combination of old and new does complicate the exercise, so let me share an analogy that has helped me. Some of you may be familiar with the children's book, Lowly Worm Meets Early Bird by Richard Scarry. If you aren't, I highly recommend it along with everything else by Richard Scarry. Lowly's a dapper worm, he wears a hat, he's got a bow tie, and naturally a single shoe. At one point in the story, Lowly and Early Bird are having a meal. Lowly is eating peas, and you can see clearly the imprint of each pea on his long body. But when you turn the page, Lowly is back to his usual slim self. The peas have been digested, and they've left no lasting imprint. That's my base case on tariffs and inflation. But Lowly is eating a lot of peas, so we need to keep a close eye on him to make sure he does not get indigestion. Given my views on tariffs and inflation, monetary policy should be focused on balancing risks to maximum employment and price stability, which means moving policy towards a more neutral stance. Why? First, because of the progress on underlying inflation excluding the effects of tariffs. Ignoring this could add unnecessary stress to the labor market. Second, labor market risks do appear to be increasing, not outrageously, but noticeably, and momentum seems to be going in the wrong direction. Against this backdrop, the FOMC's decision to cut rates by 25 basis points in September made sense. Over the rest of the year, I view easing along the lines of the median SEP policy path as appropriate. Of course, that is if economic and financial conditions evolve as I expect, and I'll return to that if in a moment. But first, what about next year? I see two important questions for monetary policy to grapple with in 2026. The first is, what is the neutral rate? And the second question is, how quickly should policy move to neutral? My short answer to these questions is, I don't know, and because I don't know, we should proceed cautiously. To expand on this just a little bit, there are a wide range of plausible estimates of the neutral policy rate, and I think we will need to feel our way there, paying close attention to what economic developments tell us about the stance of policy. The ability to go slowly and assess is particularly valuable as we get closer to neutral. We will be better positioned to go slowly in the future if we adjust policy in the near term in a way that better aligns labor market and inflation risks. I anticipate that 2026 will see growth near potential and inflation rising and then subsiding as tariffs together with current and past monetary policy restrictiveness work their way through. If the economy evolves as I expect, the monetary policy adjustments we make this year and next will be sufficient to keep labor market conditions close to full employment. If the economy evolves as I expect, it's doing a lot of work here. I'm particularly focused on the breadth of support for growth, and I see some reasons to think that it might be somewhat narrow, and this could make the economy vulnerable to shocks. To start with, virtually all of the net job growth we've seen this year has been confined to healthcare and social assistance. Employment in most other sectors has been flat to down on the year. Consumption, the largest component of GDP, has proven resilient again and again. However, there are reasons to examine the breadth of support for consumer demand as well. I've been hearing from my contacts that households, particularly on the lower end of the income distribution, are feeling the weight of higher prices and slower wage growth. In response, they've been adjusting discretionary spending and often trading down to lower cost alternatives to preserve cash flow. With lower income consumers more constrained, spending by high income households may be even more important than usual. Indeed, recent analysis suggests that consumption is growing considerably faster among high income households compared to medium to low income households. That means aggregate consumption growth is more dependent than usual on higher income households. So what is driving spending growth among these consumers? The top 20% of households by income own over 85% of corporate equity. So it is not surprising that spending by high-income households is linked to the fortunes of the stock market. And the stock market has mostly been on a tear. However, this performance has largely been driven by just a handful of firms, and the market has been quite sensitive to the narrative around AI. It seems likely that AI will have profound impacts on all aspects of the economy, but where we're currently seeing a lot of that action is in the stock market. This might all turn out great, and I see tremendous promise in how AI could eventually boost productivity. But in the more immediate term, the relatively narrow base of support for the labor market, the importance of high-income consumers, together with the prominence of the narrative around AI for equities, adds up to a relatively narrow base of support for growth over the next year or so. Indeed, some business contacts have asked, where will future demand come from? This is something to watch closely. Let me make a final point about inflation. Over the past 4 years, long-run inflation expectations from market measures have remained remarkably stable. Over this period, we've seen headline PCE inflation of over 7% and big increases in shorter-run inflation expectations. The stability of longer-run inflation expectations is an important testament to the credibility of monetary policy and to the value of that credibility. Even during the largest run-up in inflation in over 40 years, markets overwhelmingly had faith that the Fed would return inflation to 2% over a reasonable time frame. That credibility, in turn, has been key to enabling the FOMC to bring inflation down a lot while keeping labor markets at levels close to full employment. But it's critical to finish the job and return inflation to 2%. Credibility is a hard-won asset that allows us to fight inflation while preserving the labor market strength that benefits all Americans. Thank you so much, and I look forward to continuing the conversation with Greg and to your questions.
Thank you very much for those remarks. First of all, I want to congratulate you on your new role. You spent essentially a couple of decades at the Chicago Fed as a researcher, a top researcher, and now you're leading the Philly Fed. And I wanted to get your perspective on how it feels to be moving from a researcher to a policymaker and the president of the Philly Fed.
So thank you for that question, and thank you for your kind introduction. It's great to be here with all of you. When I think about my job, it feels like a continuation. I get to work with hundreds of people who are dedicated to the mission of the Fed. And what I get to do is have a broader impact on what they're doing and interact more deeply with the communities in the 3rd District. And it's just a great honor and a pleasure.
And which Fed is the best one? Chicago?
The trick question.
With each other there.
Yes.
More seriously, we're in the midst of a government shutdown. We're not getting access to data. I stressed the importance of data earlier. I think we all value data greatly. But from a policymaking standpoint, how does this complicate your role in guiding monetary policy when you don't have the public sector data? Do you rely more on private sector data? Do you just wait it out? What's your approach or preferred approach?
So I think we're doing what we always do, right? I talk to businesses, I talk to communities, I talk to leaders of nonprofits and other organizations. I'm looking at a host of data, public and private. More data is always better, but this doesn't seem like we'll see. But right now, I feel like we've got lots of really great sources of information that are allow us to have a handle on what's going on with the economy.
Now, you mentioned in your address that you were essentially in line with the median estimate for the Fed funds rate, seeing another 2 rate cuts this year. Are you also in line with the median estimate for next year in terms of monetary policy?
I think next year we're going to have to really evaluate the data as it comes in. We're going to have to see what happens both with inflation and with employment and with growth, right? I mean, I think next year is a long way off right now.
So in that regard, I mean, Powell mentioned that there's no risk-free path, right? When the inflation and employment mandate are moving in opposing directions. How do you address this potential tension between inflation moving higher and the labor market potentially weakening, which you highlighted as a downside risk?
So I think, so if you look at the consensus statement, right? The FOMC has a statement that describes, how we do our job, what are the principles that we follow. And in it, it describes, when the two goals are in conflict, that we're going to look at how far each one is from their target, and then, what's the time frame over which we can reasonably expect them to get back to target. I mean, I would say that you're going to take different actions when inflation is 7% than when inflation is 2.5% in order to bring inflation back down, in terms of the risks that you're willing to take when it comes to the labor market.
So focusing on the labor market a little bit more, and you addressed this in your speech, but there is this ongoing debate as to whether what we're seeing is a significant supply shock or whether it's more of a demand shock, and what is likely the outcome in terms of the labor market balance in this environment where we've seen labor supply be severely negatively impacted by immigration restrictions, but where we've also seen a number of signs, and we were talking about this during the Outlook session, a number of signs of a weakening in labor demand, whether it's the concentration of job growth or some of the continuing claims for unemployment or job cut announcements. So where do you see the balance in terms of labor supply versus labor demand?
So I think, again, so far what we've seen is both things coming down roughly in balance, right? I think that's why, the unemployment rate has, stayed in a relatively narrow range despite ticking up a little bit in the last month or so. I think that because you've got labor demand and labor supply moving at the same time, it makes it really important to look at things like the unemployment rate, the job finding rate, things like that are ratios rather than, raw numbers to try to assess the strength of the labor market.
Which are some of the indicators you favor when evaluating that?
So, I mean, I do think the unemployment rate is kind of our best one. If we have to pick only one, and we don't have to pick only one, so this is not the exercise, but if you only had to pick one, you would pick the unemployment rate.
So, I mean, this question, speaks right to the notion of the break-even rate, right? The number of jobs that's needed to keep the unemployment rate constant. Have you looked into where you might think it might be today, given what we've seen in terms of immigration developments?
So I know it's lower than it was before. And it seems likely that it's low enough that we're going to have a hard time telling, it's going to be within the standard of error that includes some things that are negative. And so I think that's another reason why I think it's really important to look at ratios rather than like those job flow numbers, because when you've got supply and demand changing at the same time, it's really hard to assess, what is the break-even rate? It's changing over time. We've got, structural things going on at the same time that cyclical things are going on. And so that's why I'm going to be looking at some of those ratios.
So that pretty much aligns with the NABE Outlook survey, where we have essentially 2/3 of the panelists that think that the break even is lower than 75,000. So I don't know. Do you think it's lower than 75,000 or?
That sounds really reasonable to me. I would suspect that it's lower than 75,000. I think it was probably lower than that if you go back to pre-pandemic days too, right? The demographic trends are pretty inexorable.
One interesting paradox I find in the economy is that you have the labor market that is slowing. You have slower job growth, and yet you still have resilient private sector activity. So the way to bridge that gap, that puzzle, is essentially to assume that there is stronger productivity growth.
Yeah.
How strong do you believe productivity is right now, and what do you think are the sources of that strength in productivity?
So I think that's part of the feeling your way that I talked about with trying to understand where neutral policy is as we go into 2026. And what I would like, one of the reasons for doing that, and one of the benefits actually of Fed credibility, is it lets you look at things like higher job growth higher economic growth, and assess whether or not that might be due to fundamental changes in productivity that are going to be lasting and that are going to, allow us to have higher potential growth that's not inflationary. And so I don't want us to have to step on a productivity boom because we're worried about where neutral is. That's why I think it's really important to be able to go slowly. And so I don't know how that's going to play out. I think there's tremendous promise for productivity to be higher. We saw huge business formation during the pandemic, and those trends have stayed higher. I think some of the ways in which we've seen fewer price increases than people had anticipated due to tariffs is a testament to the creativity and the agility of American businesses. And so I want us to be able to explore what productivity growth is going to be. And I think it's really important for us to follow that story as we go forward.
It's very interesting because the economy right now is going through a number of supply shocks, which is highly unusual and very delicate to navigate from a policymaker standpoint. Any central bank that is facing a supply shock has this tension as to what it should do. You mentioned that when it comes to tariffs specifically, you believe that these are going to create a one-time shock, and that the Fed would be best positioned to essentially look through these shocks. But how do you assess the potential for a more persistent inflationary shock from tariffs? Where would that come from?
So that's really what I was addressing in my remarks. When I look at economic conditions right now, and when I think about what I hear from business and other contacts, I don't hear the kind of demand conditions that seem likely to turn these, potentially a series of supply shocks into an ongoing inflation problem. So I think when you look back at the pandemic and when inflation rose really rapidly, you had a supply shock and a demand shock at the same time. And what I think we have now is a supply shock, but we don't have that accompanying demand shock that would tend to make turn the supply shock into an ongoing inflation problem.
So, and one of the vicious things about supply shocks is that they have these opposing effects on output and inflation, contrary to demand shocks, which tend to be pro-cyclical. When you think about, and you alluded to that, when you think about the different influences from tariffs, from immigration, from the technological revolution that we're currently living through, where do you assess the neutral rate for monetary policy? Where do you see that being influenced? Because there are some factors that are lowering it, pushing it lower, and others that are raising it. So where do you assess the neutral rate to be right now?
So I think that's the piece where we're really going to have to feel our way. And I think that's partly, again, we're seeing cyclical things and structural things happening at the same time. As you mentioned, they can push the neutral rate in different directions. And so I think that's the place where it's going to be important to see how the economy responds, both to these structural and cyclical factors that are feeding their way through and to the stance of monetary policy, and to get a sense of whether or not, policy is restrictive or maybe it's less restrictive than we think. So I think we're going to learn that over time, and then we'll have to respond. But again, I think that gives the economy the best chance to, protect the labor market, keep inflation contained, and then, not step on a productivity revolution if that's what's in train.
And if you had to balance the immigration shock, just to come back to the NABE Outlook survey as a reference point, the estimate, about 2/3 of the panelists believe that the drag from immigration is going to be between 0.25 and 0.75 basis points in terms of GDP growth. And the boost, the lift from AI in terms of right now, what we're seeing is the CapEx boom, but the potential for a productivity boom later. If you had to balance the two, do you think they offset each other, or do you think one is stronger than the other in terms of its persistent impact on potential output growth?
So I think this is going to depend, over what horizon you want to think about that question, right? I think the very fact that we're structurally scarce labor, and we have been structurally scarce labor for a long time if you look at demographic trends. And I think that gives businesses great incentives to think about ways in which to produce things with fewer people, right? I think that's actually good for all of us because of those structural issues.
So we have a lot of questions coming in here. One that is interesting here is the question around, and this ties into the AI question, but there's been a rise in youth unemployment. Do you view this primarily as a result of cyclical factors, so a slowdown in the economy, which means younger individuals are less likely to be hired, or do you see this more as a structural factor, essentially influenced by technological developments and potentially AI?
So I think it probably depends on which part of the youth unemployment numbers you want to look at. If you look at the tick up a little bit, and I think for new college grads, that seems like something potentially you would want to understand. As that it's rare for that number to tick up, and so I think you'd want to understand that as potentially being due to something that was more structural in nature. Whereas I think, teen unemployment is very cyclical, and so I would expect that to be driven by cyclical factors.
So this is an interesting one. It goes back to the question that we were discussing about the neutral rate, and so where that may be moving. But the question is, how do you assess the stance of monetary policy in real time? So not in retrospect, but really in real time.
Yeah.
How do you do that?
Yeah. All right. So, so that's going to be, an art and science. So I think that's going to be part of, I'm going to talk to people. I'm going to look at all of the data. I'm going to use judgment. I'm going to be looking at economic models. I don't think there's no magic formula to figuring that out. And so I think that's going to be something that is, going to be an ongoing challenge and, something that's really important to do all the time.
In that regard, there are some policymakers that have warned against dogmatic data dependence. Mickey Boutman mentioned that, and Governor Waller has said that the Fed should be more forward-looking. Where do you land in that debate between data dependence and having more of a forward-looking perspective, potentially integrating scenarios into policy planning?
So I think that scenario planning is always really useful. It's helpful to think about, not to get locked into one view of the economy or one view of almost anything, and so to consider other things that can happen and to be thinking about, well, what should I be watching for if this other thing might happen or whatever it might be. So I think that's just, prudent policy making, prudent business planning, prudent thinking about a whole range of different things. And then what was the rest of the question there?
No, just where you stand in terms of having both balancing.
Okay, sure. So I think you always have to be doing both, right? I don't think that there's any choice about that, right? I emphasize that monetary policy works with a lag. I think that's very true. And so that means you have to be thinking about both where is the economy now and where is it going? And what are the things from the past that are impacting it today? And then and how might they play out in the future? I think that you really have to do both.
In terms of the transmission of monetary policy onto the economy, the Fed has the control of the Fed funds rate and its balance sheet as two of the primary tools to conduct monetary policy. But long-term rates are really what matter perhaps the most in terms of guiding economic activity. In the current environment, and we had a session before this where there was a discussion around the fiscal trajectory for the U.S. economy. There was a lot of questioning and debating, how and when we would address essentially the fiscal situation, which seems quite concerning. And one of the suggestions was that the markets would essentially push Congress makers to actually act upon the federal budget. So I'm not going to ask you about fiscal policy, but I am going to ask about how you consider the environment where long-term rates are not falling by nearly as much as short-term rates imply. How do you bridge that disconnect in terms of monetary policy transmission when the long-term rates are not reacting in the same way?
So, I think that comes back again to trying to gauge the impact of policy on the economy. And so looking at the entire yield curve, but also looking at all of the economic data. The Fed obviously can only control short-term rates. There's 1,000 things that move around longer-term rates, and that's always going to be true. And so I think you have to, again, be sensitive not just to what's the level of rates, but what are we seeing in terms of business formation? What are we seeing in terms of growth? What are we seeing in the labor market? What are we seeing in terms of sentiment, both from consumers and businesses, to assess the overall conditions?
And so when you mentioned that you viewed the optimal path as being aligned with the median expectation from the dot plot, you also mentioned that this was conditional on financial conditions remaining as they are. How do you assess this split between financial conditions that may be loose on average, but may be tight for certain types of private sector actors? So what I'm thinking about here specifically is you think of a potential home buyer looking at a mortgage rate that is historically elevated, and you think of financial conditions, you take any type of financial conditions index showing fairly loose financial conditions. So how do you balance those two? I think it goes back to the narrow base for growth that you were highlighting.
I mean, I think that's exactly right. I mean, there are always going to be, I think, through a wide range of financial conditions, there's going to be folks who you can talk to who are like, I can get financing, things look good for me, right? And then there's going to be other people who are always saying that they can't get financing and things don't look good for me, right? And sometimes those are higher income households and lower income households. Sometimes that's big firms and small firms, so there's that constant part, and then there's the cyclical part of it. And so, again, I think it comes back to assessing the entire range of all of the data to try to figure out what's going on. And what we're seeing right now, right, is the unemployment rate ticking up. We're seeing growth, it's moving around a lot, but it's been very strong this past quarter, and it looks like this current quarter is going to be good. Again, looking further out, it's a little bit harder to see where that growth comes from on a sustainable basis. And so I think that's the part where we're going to be wanting to follow the data.
Now, we've been talking about easing monetary policy.
Yep.
But we do have the risk that inflation proves to be stickier than previously anticipated. We've already run through one experiment in that regard. There is the risk that inflation passes through from goods prices onto services prices, especially for services dependent on goods. You can think of the healthcare sector where a lot of equipment is imported. You can think of auto repair shops that might import different parts to repair cars. In an environment where inflation proves to be stickier than you are currently forecasting, how would you react in terms of monetary policy? In other words, do you see the potential for rate hikes next year and the Fed having to tighten monetary policy because inflation proves to be stickier?
I mean, I think you can never say never about that. I mean, if inflation, shows a burst of, shows some life, then the Fed's going to have to react appropriately, whether that's, keeping the policy rate at, current levels, or whether that's increasing it is going to depend on what the data say. But I think we need to be open to doing what it takes to achieve both of our mandates.
How do you see the Fed proceeding with regards to the management of its balance sheet? How do you see that evolving over the course of the next few months?
So I think in terms of the balance sheet, the balance sheet is an important tool when the Fed funds rate is at zero and when the economy is constrained by the zero lower bound. And then the actions that you take then to support the economy, persist over a long time period. And the FOMC has said that it's going to implement monetary policy in an environment with ample reserves. And so that means certainly a balance sheet that's bigger than it was, pre-Great Financial Crisis. And it's been shrinking, gradually for some time now. And I would expect as we look out over, I'm not going to hazard a guess to the number of quarters, but it's, at some point we're going to reach the point where we're at that ample level. And then, it can stay there for a little while, and then it needs to start growing again with the demand for reserves and with currency.
Now, a question that just came in has to do with what you were highlighting in terms of the base for growth. The fact that consumer spending on average is still doing relatively well, growing close to 3% year over year, but the different income groups are not spending equally. The higher income individuals are doing more than their fair share of spending. The question is, does this indicate that there is some widespread pain that is hiding in the distribution of spending? And can the Fed actually do anything about that?
So I think that there's structural things in the distribution that mean that there are always, some people who are doing better and some people who are doing worse. And so then the question is, what part of that is cyclical and matters for monetary policy? So what part of that has a signal for how tight conditions are, the prospects for growth, the prospects for inflation? And so that's what I'm really focused on. And I think that the Fed has to be focused very clearly on maximum sustainable employment and on 2% inflation. And those, achieving those two things confers the best possible benefits we can provide to all American people.
When it comes to inflation expectations, there's been a lot of volatility. There are a lot of different indicators.
Yes.
There's the consumer sentiment gauge. There are market gauges. There's the New York Fed gauge. I mean, there are a number of different indicators, and they're all pointing in the same direction, but they're not to the same degree. Are you concerned that what we are getting from some of the gauges may be misleading in terms of where people see inflation going over the next year or so? Are you concerned that essentially we're not getting a proper read on where people think prices will be heading, and that may essentially distort the perception of how restrictive monetary policy should be?
So I've spent a lot of time looking at those data and the individual survey data from households in particular. My goal was to try to see if are there some households who are kind of like the canaries who are going to chirp first when there's an impending inflation problem. Basically, the results of that were I can't find them. Maybe if we had bigger surveys, you could find them. But I think that, you have to use judgment and look at a lot of different data. I think that I've found generally that the market expectations are more reliable than survey expectations. But I think it's important to pay attention to all of these things. And there may be times when you're learning something really important from the household surveys as well.
And so if we were to extrapolate into the future, I think one of the key concerns that a few economists have is the risk that inflation remains persistently higher than the 2% target, not for cyclical reasons, not because of policy, but because of structural factors, a reduction in immigration, a more rapid aging of the population that requires more healthcare spending, for instance, an environment where you have more trade fragmentation and where the cost of doing trade is persistently higher, an environment where there is more spending on AI and digitalization, which also leads to higher pressures for energy, for instance. How concerned are you about the prospects of essentially a struggle to get back to the 2% target? In other words, that inflation would be consistently above that 2% target over the medium run. So, the FOMC's clearly stated that the goal is 2%, and I think it's really important to achieve that. I think that that's, the key to credibility, and that credibility is the thing that lets you weather a high inflation episode and bring it down without damaging employment. It's also the thing that lets you ride out a productivity wave and see if it's going to generate lower inflation that would benefit everybody. So I think that you really need to be focused on 2%. Okay. And then my final question, with regards to the dollar, we've seen downward pressure on the dollar as a result of investor diversification, and recently it's actually been quite stable. It's moved in the opposite direction that is usually anticipated when countries impose tariffs. When you look at the evolution of financial conditions, including the evolution of the dollar over the course of the past year, how concerned are you about the U.S. potentially losing its reserve currency status? So that isn't something that really is keeping me up at night right now. I know there's a lot that's written about it, and a lot of people are focusing on that. But this, we've got there are 1,000 reasons to invest in the U.S. There are, that we've got, the economy is doing really well. So that isn't something that I'm super focused on at the moment. Okay. So on that great note, let me thank Anna for joining us today. Thank you so much. That was